Howdy, everybody. Welcome to the Liberty Call. Today is Wednesday, February 19th, 2025. Hope you're having a fantastical day out there in the interwebs. It is quite chilly here in Colorado. I think the high today is in the mid 20s. It is sunny, so we can at least count our blessings there. So, anyways, hope you're having a fantastical day out there. Markets are slightly down as investors digest Trump's latest tariff threats and await the Fed's meeting minutes, which we're going to cover in a little bit. The S&P and Dow are slipping while the NASDAQ holds steady. It looks like they all finished in the green at the close. Intel is down nearly 3% on reports that it may sell its Altera chip unit, while Supermicro is rallying on AI server growth. Meanwhile, Nikola has filed for bankruptcy, sending its stock plunging 39%, while Tesla gets a 2.4% bump. And in a major shift, the SEC is cracking down on shareholder proposals, dialing back its 2021 decision on environmental and social resolutions. All right, well, before we jump in and break it all down, I need some help from you. If you could give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All righty, well, let's hop into today's markets. Dow Jones was up 0.16%, 71 points, closed at 44,627. S&P 500 up 0.18%, 11 points, closed at 6140. NASDAQ up 0.07%, 14 points, closed at 20,056. The VIX was down 0.78% today. It's at 1523. Canada down 0.09, Brazil down 0.98, and Mexico down 2/3. Let's see here. In Europe, Germany was down 1.79%, the UK down 0.62%, France down 1.17%, the Netherlands down 0.5%, Spain down 1.63%, Italy down 0.53%, Switzerland down 0.79%, and Portugal down 0.19%. Russian exchange is green today. MOX up 0.4%, RTSI up 1.41%. And the overnight markets, the Nikkei Japan was down 0.34%, Australia down 0.73%, New Zealand down 0.45%. China, the Shanghai was up 0.81%, Shenzhen Component up 1.46%, China A50 up 0.26%, DJ Shanghai up 1.04%, Hang Seng down 0.14%, and the Taiwan weighted down 0.26% for the day. All righty, so that's that. Let's hop into our market recap. S&P 500 hits fresh record highs after uneventful Fed minutes. The S&P 500 reached new record highs on Wednesday, buoyed by investor confidence that the Federal Reserve will maintain its cautious approach on interest rates. The major Wall Street indices all closed higher, with the S&P 500 leading the charge after fluctuating near the flat line most of the session. The Federal Reserve released the minutes from its January meeting, but they offered a little new insight into monetary policy. The notes confirmed the Fed's stance that additional evidence of continued disinflation would be required before considering rate cuts. This aligns with recent comments from Fed officials, easy for me to say, reinforcing expectations that rate cuts will remain on hold until inflation moves closer to its central bank 2% target. The minutes also noted resilience in the broader economy, giving the Fed further reason to remain patient with monetary policy adjustments. Apple remained flat despite unveiling a lower-cost iPhone model, the iPhone E, set to launch later this month. The move is seen as an attempt to boost demand in price-sensitive markets. Arista Networks dropped more than 6% as analysts highlighted a year-over-year decline in revenue from Meta Platforms, a key customer of its networking equipment. Occidental Petroleum jumped nearly 5% after announcing production forecasts that fell short of estimates, but revealing a $1.2 billion divestment of its upstream assets, signaling a strategic shift in its portfolio. And Etsy tumbled 8% after missing Wall Street revenue expectations for the fourth quarter, raising concerns about slow growth in its e-commerce business. Overall, investors continue to weigh inflation trends, corporate earnings, and Fed policy signals as markets push higher. All right, so that's that. Let's jump into some data here. January housing starts. This comes to us via First Trust and Mr. Nate Gersey. So let's see what he had to say. U.S. housing starts fell 9.8% in January, reversing December's surge, but the decline may not be entirely reflective of a broader trend. Harsh winter weather likely played a role in dampening construction activity. The drop was broad-based, with both single-family and multi-family starts declining, and 3 out of 4 regions seeing decreases. Compared to a year ago, housing starts are down 0.7%, while permits for new builds fell 1.7%. Both metrics remain near 2019 levels, signaling continued supply challenges for prospective buyers. One key reason for the slowdown in new home construction is that builders have been focusing on completing existing projects rather than starting new ones. Home completions jumped 7.6% in January and are up 9.8% from a year ago, reaching their fastest pace since before the pandemic. However, the total number of homes under construction has fallen 15.6% over the past year, a decline typically seen during housing downturns or recessions. Despite this, analysts don't anticipate a housing bust. Since the 2007 housing crisis, the U.S. has consistently built too few homes to meet demand, and the country still needs a pace of at least 1.5 million new homes annually to keep up with population growth and house replacements. With persistent supply shortages, home prices are expected to continue to rise in 2025, despite broader economic uncertainty. Meanwhile, home builder sentiment took a hit in February, with the National Association of Home Builders Housing Index dropping from 242 from 47 in January, indicating more builders view conditions as poor rather than favorable. On the manufacturing side, the Empire State Index, measuring factory activity in New York, rebounded to 5.7 in February from a negative 12.6 in January, showing some signs of improvement in the sector. All right, so it's kind of half good, half bad. All righty. And last up, I got the minutes from the Federal Open Market Committee meeting on January 28th and 29th. We're going to run through this real quick, and then we'll be done. Woohoo! All right. The Federal Reserve continued its review of monetary policy strategy, tools, and communication, focusing on refining its longer-term goals. The 2% inflation target remains unchanged, but participants discussed potential adjustments to policies introduced in 2020, particularly those addressing economic risks tied to the effective lower bound and employment shortfalls. The committee acknowledged that economic conditions have shifted significantly since the last review in 2019 and 2020, which was shaped by the post-Great Financial Crisis trends of persistently low inflation and interest rates. Well, I don't know if the inflation was really that low. Rates were held at zero for a better part of a decade, but I don't know if inflation was really low. I mean, it was there. We just didn't really see it. Staff presented insights from international monetary policy reviews, highlighting how central banks globally have reassessed inflation targeting, forecasting, and communication strategies, especially after the COVID-19 shock and subsequent inflation spike. The Fed's review is expected to conclude by late summer of 2025, with findings reported to the public. The FOMC decided to maintain the federal funds rate at 4.25 to 4.5, confirming investor expectations of a prolonged pause in rate cuts. While inflation has eased over the past 2 years, it remains above the Fed's 2% target, with PCE inflation at 2.6% and core CPI at 3.2% in December. Participants noted that further evidence of sustained disinflation is needed before considering rate cuts. The Fed acknowledged that economic growth has remained strong, led by consumer spending, business investment, and productivity gains. However, there were concerns about rising consumer debt, delinquencies, and potential economic strain on lower-income households. Financial markets saw moderate equity declines and slight increases in credit spreads, while Treasury yields fluctuated in response to shifting economic data. The Fed's balance sheet reduction efforts remain on track, with security roll-offs continuing through mid-2025. Surveyed market participants now expect rate cuts later than previously anticipated, reflecting the resilience of the U.S. economy. The Fed reaffirmed its commitment to reducing Treasury and mortgage-backed security holdings, gradually aligning its balance sheet with outstanding Treasury debt. However, concerns remain about potential financial market disruptions, particularly in commercial real estate and the banking sector, where rising long-term interest rates could stress some institutions. The unemployment rate remains low at 4.1%, with stable job growth averaging 170,000 new payrolls per month in late 2024. Wage growth has moderated, supporting disinflation, but the housing sector, insurance costs, and trade policy uncertainties could add inflationary pressure. Participants expressed mixed views on whether labor market conditions would contribute to inflation in the near term. And looking ahead, the Fed remains cautious, signaling that further rate cuts are not imminent. The committee will monitor incoming inflation data, employment trends, and financial market conditions before making adjustments. With economic uncertainties, including trade policy, global supply chains, and geopolitical risks looming, the Fed's next move will hinge on inflation's trajectory and broader economic resilience. The next meeting is scheduled for March 18th and 19th of this year. All right. That is it. So basically, that was a lot of words to say they aren't doing anything, and they're really going to pay attention to what's going on in the economy. Okay. So just like everybody else who's watching the news and everything else. So, anyways. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All your financial planning needs can be addressed there. So give me a call or an email. I'll be happy to help. All right. Well, hope everyone out there has a wonderful evening, and I'll talk to everyone again next time. Adios.